Welcome to our in-depth strategic breakdown, U.S. Private Equity 2026 Outlook. We are tackling the great exit backlog and the intensifying fight for capital. This analysis provides a comprehensive overview of the 4 core trends reshaping the private equity landscape in the United States for 2026. Our focus centers on 4 strategic trends: slower exits and aging assets, the consolidation of fundraising into mega funds, a resurgence of platform LBOs, and the expected peak and decline of continuation fund activity. Before we dive in, please note, this video is for educational purposes only and is not financial or investment advice. Always consult a qualified professional for personalized investment decisions. Trend number 1 is the great exit backlog. Years of slow exit activity have created a significant pile of aging portfolio companies. The data is clear. 30% of U.S. private equity assets are now 7 years or older, significantly exceeding the typical holding period. This necessitates accelerated exit planning for GPs. The backlog is compounded by 3 key factors: muted IPO markets, cautious corporate strategic buyers, and fewer sponsor-to-sponsor deals. The 2021 LBO cohort is exiting at a significantly slower pace compared to the 2017 cohort. This difference is structurally compounding the aging asset problem, creating immense pressure on general partners. Limited partners are demanding distributions over paper returns, shifting the focus from NAV increases to immediate, tangible cash flows, also known as DPI. Unsurprisingly, the primary area of focus for investors in the coming months is explicitly exiting portfolio companies. We expect a growing reliance on strategic buyers, especially in healthcare and software, alongside a denominator effect cleanup, which pushes LPs to prioritize distributions in 2026. Trend number 2 is the profound consolidation of fundraising, creating a significant flight to quality in the market. The fight for capital is heavily skewed. The top 10 funds captured a staggering 45.7% of all capital raised year-to-date 2025. Limited partners are increasingly demonstrating a flight to quality, preferring established platforms with proven track records and reliable returns over emerging managers. As a result, smaller general partners are facing elongated fundraising cycles, with many reporting processes taking 12 to 24 months to close a new fund. We are observing increased GP stakes transactions as firms seek permanent equity capital to anchor future strategies and weather the fundraising consolidation. Limited partners are leveraging their capital to negotiate tighter terms, including fee breaks, enhanced co-investment rights, and clearer transparency on ESG factors. Mid-market funds are finding a growing reliance on family offices, which are emerging as significant and flexible capital sources outside of traditional institutional limited partners. The harsh reality of consolidation means a significant squeeze on first-time and emerging managers who lack the historical track record necessary to secure large capital commitments. Moving to Trend 3, we anticipate a robust resurgence of platform-leveraged buyouts in 2026. There is a notable shift back toward large-scale platform LBOs, with projections showing they will account for 25% or more of total deal activity in 2026. This resurgence is underpinned by healing leverage markets, marked by private credit spreads tightening and syndicated loan markets reopening for major transactions. Platform LBOs are set to account for over 25% of all buyout activity, reflecting improved financing conditions and a greater capacity for large deal execution. Deal teams are shifting focus toward add-on acquisitions. This strategy drives inorganic growth and is a crucial lever for scaling platform companies. The strongest LBO pipelines are found in tech-enabled industrials, specialty manufacturing, and resilient healthcare services. Operational value creation is becoming far more important than purely financial engineering. Disciplined execution and operational improvements are key drivers of success. To underwrite faster and deeper, deal teams are increasingly leveraging AI-driven commercial diligence for sophisticated market analysis. The underlying financial drivers for the LBO resurgence are the lower cost of capital and intense competition in the private credit and BSL markets, leading to tighter spreads. Our final trend addresses the continuation fund market, which is expected to peak and subsequently decline in 2026. 2025 confirmed the peak for continuation fund exits, with approximately 133 year-to-date transactions providing liquidity for long-held assets. As traditional IPO and strategic exit channels reopen, continuation fund activity is projected to fall back to normalized, lower levels in 2026. There's growing LP fatigue regarding continuation funds, centered on concerns about conflicts of interest, inconsistent pricing transparency, and the recycling of aging portfolio assets. Only the very top-tier general partners with strong credibility and highly sought-after assets are expected to continue raising and deploying large continuation vehicles successfully. Net asset value financing, or NAV financing, is emerging as a critical supporting liquidity tool in the background, providing more flexible capital solutions. Secondaries funds are pivoting their capital allocation back towards LP-led transactions, moving away from the GP-led continuation funds that dominated 2024. The primary reason for the decline in CF activity is straightforward. Traditional exit avenues like IPOs and M&A are finally reopening in 2026. Now let's examine the sector focus and overall investor sentiment heading into 2026. Technology and AI stand out, offering the highest potential upside at 34%, but also carry the highest disruption risk, cited by 22% of investors. The healthcare sector remains stable, favored for its non-cyclical demand, recurring revenue models, and a strong pipeline of corporate carve-out opportunities. Industrials and energy transition are gaining traction, specifically infrastructure-light decarbonization assets, which are seeing increasing investor interest. The consumer and retail sectors continue to be challenged, grappling with persistent inflation and rapidly changing consumer spending behaviors. Investor sentiment is optimistic. 61% of respondents anticipate that exit opportunities will improve somewhat in the next 6 months. The private credit boom is proving instrumental, enabling larger buyouts to close earlier than market commentators initially expected. In conclusion, 2026 will be defined by discipline and the ongoing battle to monetize the vast exit backlog. The year will favor managers who prioritize underwriting quality and disciplined deal assessment over speed in deployment. While the exit backlog is clearing, value creation expectations remain exceptionally high across all sectors and investment types. Capital concentration means the strongest, most resilient platforms will continue to scale rapidly, while weaker firms will face pressure to consolidate or exit the market. Ultimately, the focus for U.S. private equity in 2026 shifts firmly back to operational value creation and highly disciplined deployment.